our special attorney to talk to us about this wonderful form. We've talked about some in our classes and our timetable. And several of you have asked for more explanation on it, so we have Lisa to do that for us. Thank you, Lisa, for your time.
Hi, I pre-warned Liz too. I mean, there's only so much that you can do in talking about this form. So I'm going to try to give you the basic overview, kind of go through the potential exceptions, and then it's probably going to be a lot more fielding questions and answers, to be quite honest, because there's only so much you can teach when it comes to this very limited topic. So we'll start basically with the whole idea of the non-resident withholding tax. That's kind of what I'm here to talk about. So you start with a situation where you've got to determine, do I have a South Carolina resident or do I not have a South Carolina resident? And believe it or not, sometimes that is a very area. So a South Carolina resident, technically, if you go look at the statute, just says it's an individual domiciled in the state. You then go to try to find what does domiciled in the state mean. And the legal definition, according to the statute, said a person's fixed home where he has an intention of returning to when he is absent, and that you can only have one domicile. So technically, I don't have to live here very long, but if this is my home, and even though I go travel somewhere and I stay there 11 months and I come back, because this is my fixed home, my intent is always to return here at some point, then technically this is my domicile. Technically, I am a resident. Okay? It gets gray in some of that because you also, obviously, if you're a resident, need to be filing tax returns. So if I go move away and I keep this house, but I'm not filing tax returns here, and I start filing tax returns in another state, then this is probably not my domicile, probably not a resident. For the most part, a lot of our closings, you're a South Carolina resident. So you don't even notice it. You don't get asked many times. The attorney basically has the client sign the form that I gave you, which is kind of like the exemption form. So at every closing, the attorney is going to have the seller sign an I-295 form. Because what the law says is that if I am the buyer and I have a non-resident seller who's selling property, that it becomes the buyer's tax liability to either withhold that money, which basically means the closing attorney is going to do it, or to make sure that there's an exemption form signed. So you have to have one or the other, and the closing attorney is taking care of that on behalf of the buyer, because at the end of the day, it's the buyer, because they know they'll never be able to go get the seller who's in another state and ever get the money back if there's any money owed. So they shift that to the buyer's liability. So obviously the first exemption, the top up is obvious. It's what county is the property in, what's the tax amount number, when is it closing, what's the seller's name, what's their federal ID number. The exemptions start kind of at number 9. So the first one is easy, and this is the one that's probably getting checked at most closings. They're saying they're a South Carolina resident filing South Carolina tax returns. So that's going to give them an easy out. That gets checked at closing, gets signed, and nobody ever worries about this again. The next easiest box to check is under number 15. 15 basically is, this is my primary residence. I lived here 2 out of the last 5 years, so I don't owe federal tax, therefore I don't owe state tax. So I could have already moved away, not be technically a South Carolina resident anymore because I've moved, but I owned this property, 3 years ago for 2 years. So I can check number 15, and I'm exempt, and therefore nobody has to worry about withholding any funds. Another easy one is 17. It is part of an employee relocation. So again, they relocated at some point. They were a resident at the time. They can check box 17. Wow. Those are kind of the easy ones. 11 is obviously we don't see a lot, tax-exempt organizations, but if you don't owe taxes. The next one that we see mainly when we're dealing with a non-resident is number 12. If the seller does not tell the closing attorney what their gain is, the closing attorney is required to withhold 7% of their proceeds, period. So if you've got a seller who's not going to tell somebody their gain, the attorney has no choice but to take 7% of the bottom line and remit that into the tax commission, and then they've got to worry about filing a return or an amended return later if that number was in fact wrong. So normally what we deal with is trying to have that seller, who's a non-resident, come up with what their gain amount is. That's the one we see most frequently when you have a non-resident. So if it's a non-resident individual, it's 7% of their gain. If it's a corporation, it is 5% of their gain. So the next $1 million and the biggest problem is, well, what's my gain? I don't know how to calculate my gain. How am I supposed to say what my gain is? The best thing that you can do as a realtor is say, go talk to your accountant. The attorney's not even going to tell them what their gain is or help them calculate it because of liability purposes on that behalf. And some people will say, well, I don't have an accountant. Well, you need to get one and you need to calculate it, because if you don't, we're going to have to take 7% off. So the key to me is for y'all is kind of at the beginning of the process. It's nothing worse as we get closer to a closing and we suddenly ask the seller what your gain is, and they're like, gain? What are you talking about? What's non-resident withholding? Nobody ever told me about this. So I think for y'all's part, the key is making sure the seller is aware. So you're the listing agent, you've got a non-resident seller. Go ahead and let them be working on this, because again, sometimes it's not an easy calculation and we'll talk about how you calculate the gain in a minute, but there becomes problems because you don't know what they've depreciated over the years on their tax returns. So their basis could be a lot lower than what you think it is. Typical basis that they've ever depreciated is going to start at what they paid for. So people will look on the deed and be like, oh, I know what their basis is. But the problem is that they've been depreciating over years, that basis keeps getting lowered and lowered and lowered. Therefore, they have a bigger gain when they go to sell. And there's no way anybody's going to know that except them or their accountant from their tax returns to be able to make that calculation. So it's really important to be informative. Sometimes we deal with, a lot of times, we've got two sellers. Maybe we have a child who's living in the home, it's the classic, and we got a parent who doesn't live in South Carolina on the deed with them. Maybe they help them buy it. So we have to deal with both of them. We can have the one seller say they're a resident, and their part is exempt. But the parent's part, if they weren't residents, whatever that percentage is, whether it's 50% or 20% or 70%, we would have to deal with the non-resident withholding tax on. Sometimes that parent can say, you know what, I was just on it, I'm not getting any of the money, so I'm going to sign that my gain is 0, and everything gets reported to my child because it's their home, I'm getting no money out of this deal, I have no gain. And that's okay. But starting those conversations ahead of time is the best thing you can do for your client and for the closing attorney later on who's getting yelled and screamed at about this gain and why did somebody tell them about it before. So always asking those questions on the front end is kind of big. So gain, and everybody says, well, how do we calculate gain? You can actually, believe it or not, on the IRS website, you can Google how to calculate gain, and there's actually a revenue ruling that tells you how to calculate it. But the gist of it is, you're going to start with what's your basis. Well, your basis is what you paid for it, plus certain expenses that you had in the beginning when you bought it, legal fees, title search fees, anything kind of lender fees even they allow you to add in. If you made capital improvements to the property, you're allowed to add those in. So you put a new roof on, you put a new AC system in, things that are major capital improvements. And actually on the website, there was a list of what they consider as a capital improvement. And I'll just read you some of the examples. You added a bedroom, bathroom, deck, garage, porch, patio. You put in storm windows or doors, a new roof, new siding, a satellite dish. You insulated your attic, your walls, your floors, your pipes. You put in a new heating system, central AC, furnace, ductwork, humidifiers, central vacs. Plumbing, you put in a new septic system or water heater. Interior, appliances, floorings, carpeting, fireplaces. So all the stuff that's big basically is a capital improvement. So that can, go into it. So again, this is reducing potentially what their gain is. You're also allowed on the back side to take off the expenses because they're paying, a commission out to the real estate agents. So you take that sales price, you again reduce off the commissions, the expenses of sale, the deed stamps, the attorney fees, any costs that were contractually obligated. Maybe they paid some costs for the buyer. So we keep subtracting all these things off, and at some point you end up with a number. And you think, okay, this is pretty easy to calculate. But the problem again is the depreciation. You won't know what they depreciated by looking at all of this. Only they're going to know, and their accountant's going to know what they depreciated, because that could lower their, what they call their adjusted basis substantially. So it's really important, especially when it's investment property. Chances are you know your seller's been depreciating it over time, which is going to potentially increase their gain. So for y'all, the key is making sure that you know if your seller is a resident or not, having them ask their accountant if they're not. You can be, well, the other part that's a little bit hairy. So I can be a non-resident, but if I've been renting my property, one of the exceptions, which is number 10, is if I have been filing South Carolina tax returns, because I had income here because I've been renting the property. So I've been filing South Carolina tax returns for the last 2 years, then I'm deemed a resident, because they're going to expect, because you've been filing, that you're going to continue to file, because you probably had income that year for rent. So as long as they have filed 2 out of the last 5 years, they could choose box 10. So even though they're a non-resident, they can choose box 10 if they've been filing tax returns. Lately, I've had a slew of,
They haven't been.
they haven't been. Oh, you've had all this rental income for the last 5 years and you've never filed any tax returns here? No, didn't know I needed to. Okay, well, you needed to. So we're going to have to deal with it now. So a lot of times we find that people don't realize when they have rental income in South Carolina, they need to be filing South Carolina tax returns. So if you do have them filing, which is a lot of the people, box 10 is an option. So when you're a non-resident, we're hoping that you've been filing tax returns, so we can check box 10. If we can't check box 10, we're hoping that we can go to number 12, and you're going to tell us your gain amount, and hopefully it's not going to be a ton of money, because we're going to have to withhold 7% of that. And then if not, maybe they're doing a 1031 exchange. So number 16 is an option if they're doing a 1031 exchange at closing. So they're a non-resident, they're going to, have this money go to a QI, and they're going to repurchase something. It gets a little bit complicated depending upon where you're purchasing and whether or not your QI will sign off that you're actually going to do the 1031, because the hairy part is, so let's say I intend to do a 1031 exchange, and I'm not doing it simultaneously, which nobody ever does really. I'm doing a non-simultaneous because I don't know what I'm going to purchase yet. Nobody can guarantee that you're actually going to go through with it. So just because you initiated the 1031 and the QI is holding your money, if you never find that replacement property, then you would go back to owing the 7%. So the QI has to be willing to sign something saying that if they don't complete the 1031, that they're going to remit the 7%. And sometimes it's hard to get the QI to agree to do that. I've had some that will, some that won't. So that's the only little part that's a little bit hairy on the 1031 exchange part. But a lot of times, they already know what they're rebuying. Sometimes it's in the same area, even though they're non-residents. Sometimes you already have the other contract, or you're writing the other contract. So people are a little more comfortable in letting you check box 16. So a couple of different options when you are the non-resident. But to me, the key is making sure they understand it up front, or that they know that they need to be asking the questions to their attorney or to their accountant, so that it's not a big surprise. I mean, we had a couple, in April. They can't get their accountant because they're in the middle of tax season. So their accountant's not calling them back because calculating a gain is not a huge thing for them to be doing right then. Or maybe they don't, they used H&R Block and they can't get anybody on the phone, or they're not really that familiar with their tax returns. So timing is everything in my mind, because the more time they have, the more time they know they've got to make the calculation, the easier it's going to be, and the more appreciative they're going to be that you were knowledgeable enough to let them know that up front. so there's no surprises. Nothing worse than the surprise of, you didn't know? Nobody ever told you about this? Like, okay, well, let me explain that to you. And sometimes people get upset, and I have to talk to their accountants, and I have to send them the statute. And all that could have been handled a little bit differently if it had kind of been done at the front end of the transaction, at least putting that information out there, letting them know it's something they're going to have to deal with.